Well, good morning, everyone, and welcome to our carbon offset webinar. My name is Dave Arkell, and I want to thank you for attending this 360 webinar today, talking about carbon offsetting. It's designed to help organizations like yours navigate and meet the requirements in obtaining carbon solutions. You want to know that 360 Energy has been in existence since 1995, delivering continuous improvement for customers by embedding management practices that measure energy and environmental costs and prove that they are controllable. And we work in two areas. We advise customers on how to optimize their energy procurement, reduce their operating costs, mitigate future risk, reduce GHGs, and proactively manage carbon. In the second area, we work with organizations to reduce their utility consumption, like electricity, natural gas, water, sewage, and diesel as well. 360 Energy's innovative solutions ensure that your businesses have the information and knowledge needed to make sure you make smarter decisions that result in real savings. And the intent is to speed up that process so you can capitalize on opportunities. This webinar will be presented by my colleague, John Pooley, the Vice President of Program Development of 360 Energy. John is based in the UK. He's both a chartered engineer and a certified management consultant with over 30 years in the field of energy and carbon management within the UK, the EU, and North America. I'm going to turn this over to Julie to discuss some of the housekeeping issues for everyone. I hope you enjoyed the webinar.
Thanks, Dave. So just before we get started, I just wanted to put a few reminders just in regards to housekeeping. Everybody on the webinar today is muted. We do this just to kind of cut down on background noise so everybody can hear the and see the presentation uninterrupted. If you do have questions, and we absolutely welcome questions, there is a question function in the webinar toggle window. So you can definitely, and we encourage you to please answer or ask questions, and I'll be able to interrupt John and ask those questions. And we'll have some time for questions at the end too. So today's presentation is going to be about 35 minutes, and again, with a few minutes for questions at the end. Again, we encourage you to use that question function. And without any further ado, I'm going to hand it over to John, and we'll get started with today's presentation.
Thank you, Julie, and good morning, everybody. This webinar today is one of a series of webinars we're doing that's sort of related to the 360 Net Zero Toolkit, and we are focusing today on the issue of carbon offsetting. But I think it's useful to just give ourselves a little bit of background to see where we are and why we're looking at this. And I think the background, and these are things we're going to take as read for today. You know, climate change is a major issue. It's something that we've got to do something about sooner rather than later. The main GHG is carbon dioxide from energy use, and that's one of the reasons why at 360 we're particularly interested in it. Net zero, what we talk about, that's the status where we stop adding to the levels of carbon dioxide in the atmosphere so we get some kind of stability with the climate. There's massively increasing government and corporate pressure and social pressure to meet net zero targets by 2050 or maybe earlier. And I think the key takeaway at this point is addressing net zero now will give you both business advantage and be less costly than doing it in the future. So just as a recap from previous times, how do you get to net zero? Well, there's what we refer to as a hierarchy, the things, you know, the order in which you should be doing things. You start with reduction in efficiency, the reduction of energy use, reducing GHG emissions, being more efficient. You then would look at fuel switching, so moving from high carbon fuels to low carbon fuels, considering purchasing renewable energy such as wind power, etc. Then you'd be looking at on-site renewables to take away even more emissions, and then you're going to be left with a bit of emissions at the end, which we'll explain a little bit more about as we go forward, and you get involved in offsetting. And to the side of this is carbon capture and storage, which is complex technology potentially, but is another approach to removing the GHGs that we can't stop emitting. One of the ways I like to look at GHGs and net zero is to consider what I refer to as the global bathtub. You've got to imagine that, you know, the atmosphere is like a bathtub, and the emissions are a situation whereby we are filling the bath up. Now, if we don't do something with it, the bath is going to overflow. Ideally, we want to stop filling the bath up, but if we can't stop filling the bath up, what can we do? Well, perhaps we can crack the drain open a bit and keep the level where it is. So I think that's one way or one image that you might like to think about when you're thinking about net zero. Now, this webinar, we're concentrating on voluntary use of offsetting or carbon credits as opposed to mandatory things. If we look at mandatory systems, and I'm going to give you an example of one, there are fixed detailed guidelines, there are assurance processes, and arguably being in a mandatory process is less risky space than in the voluntary or retail markets. Although one of the issues that arises when you're in a mandatory scheme, if you fail to do it, there's normally some kind of penalty. Whereas with your voluntary offsetting, there isn't a penalty in that sense. My example today of a mandatory program is the Alberta emission offset system. And this is basically where a group of organisations that are controlled within Alberta, what they're looking to do is reduce their emissions, and offsets are available, typically where people oversave, overprovide, if you like. There's verification, and by a third party, the rules, you know where you are. This kind of program is very often referred to as cap and trade, whereby a regulatory body has set a cap, and then there's trading. When we're looking at voluntary, we've got a voluntary cap, if you like, of net zero, and then we're looking at how we may trade within that. So the question's got to be, why offset? Well, I think one approach of looking at this, and it's a realistic approach, which I like to take, it's currently either not economically or technically possible to eliminate the emission of all GHGs. If you think, for example, current air travel, air freight, we don't yet have that net zero. We have Boeing talking about 100% biofuel possibly by 2030, but we can't do that at the moment. There are other emissions that come by materials going to landfill, other things like that. And again, we've still got those. Often the scope 3 emissions, if you understand your scope 1s, 2 and 3, they can be difficult to offset. The other thing is that you offset because of it's part of your plan to achieve net zero, and you get to the point where you can't at this point reduce, so then offsetting is your option. Another image to think about is carbon balancing or trading. And in simple terms, what we're looking at is, just imagine it's like a seesaw. You know, in simple terms, somebody is able to perhaps do better than somebody else, but between them they trade and they end up balancing and achieving the level that they're looking for. And in fact, in this area, we may be talking about bubbles as part of the COVID pandemic, but there have been sort of carbon trading or carbon accounting bubbles in mandatory schemes and others. So what we're looking at is we are trying to balance off one person's savings against somebody else's over emission, but overall reduce the total level. Right, we need to have some basics for this. Carbon offsets are credit or credits are usually measured in metric tons of carbon dioxide equivalent. Carbon dioxide equivalent allows us to look at different GHGs, methane and other gases, and relate them all to a single unit. And in simple terms, if we buy 1 ton of carbon offset, it should mean that there's 1 tonne less of CO2 equivalent in the atmosphere than there would have otherwise been. But here is a caveat that's going to pop up time and time again, but only if the carbon offset is high quality. Right, carbon accounting, and this is one of the modules of our toolkit, but to accurately offset emissions, you need to effectively calculate what your carbon level that you need to offset is. You need effective carbon accounting. Now, there is a big issue with carbon accounting, and the problem with it is that carbon in general is an abstract commodity. We have to infer our carbon emissions from other metrics, for example, kilowatt hours of gas used. However, we should note that if we are doing carbon capture and storage, we may actually be physically measuring carbon there. But it's worth remembering that the accuracy of carbon accounting generally is going to come down to the quality of emissions factors and how accurately you account for the original proxy measure. Should just note here as well that we use carbon as shorthand both for CO2 and CO2 equivalent. Okay, so what do you need to know about offsets if you're going to get involved in the offsetting market? And here I'm going to run through in relatively short period of time the basics. I'm sure most of you will appreciate this is a far more complex subject than perhaps it may look on the face of it, but you've got to start somewhere to gain an understanding. If you like, the devil then later becomes in the detail. So there are 2 major types of offsets, what are referred to as avoidance projects and what are referred to as absorption projects, or sometimes now being called nature-based solutions. If we look at avoidance projects, they could be renewable energy generation, energy efficiency, gas recovery and destruction. For example, methane from a landfill site being destroyed rather than being allowed to go into the atmosphere. The absorption projects, they are things like reforestation, afforestation, which is new forests, protecting forests, soil management, also issues like mangroves, wetlands, and there's a whole range of options there. So that's the 2 basic brackets that we go. The next thing we need to think about is the offset duration. Typically, people are accounting for their carbon on an annual basis. So you might at the end of the year decide you've got 100 tonnes of emissions that you need to offset. So you could buy a single one-off good quality offset for 100 tonnes and that would balance your accounting year. But there is an alternative approach, which is if you know for a forward period that you might need to be writing off 100 tonnes every year, you could be investing in a project that delivers 100 tonnes a year on year. So that is a slightly different approach, but you need to make that decision. Another decision you need to think about is, do you buy or invest? You can buy your credits and offsets from the retail market, which is a fairly straightforward approach as long as you understand the retail market. On the other hand, you could invest in a project and take ownership of the credits that are produced from that. You could be funding a new forest, a renewable energy generation project. You could be doing that within your organisation, in which case we would probably call that carbon insetting, or it could be a new forest or electrical generation, renewable generation in some other part of the world. And that really brings us on to the next sort of division when we're looking at offsets, local or global. Now, in terms of GHGs, they mix atmospherically. Wherever we emit them, they go into the atmosphere. So arguably our global bath, it doesn't really matter where the drain is, we can take them out wherever. So from the climate change perspective, the effects are the same as if you cease an emission causing activity or you enable an equivalent reducing activity anywhere else in the world. Now, global projects very often have what are referred to as co-benefits. They might provide local jobs, they might improve the standard of living, they might change agriculture in an area. However, The oversight and assurance of overseas projects may be more difficult than it is with global projects. And because of that, we do find that some people are much happier to look at projects that are local, shall we say local, where they can go and have oversight of them. But I touched on earlier, I touched on the terms about quality, and no apologies for the Rolls-Royce radiator. The Rolls-Royce is a mark that establishes high quality. So, you know, what would there be if we had a Rolls-Royce carbon offset? Well, there are three major criteria that we have to have: additionality, permanence, and unique ownership. And I'm going to run through and describe each of these. I'm going to say before I get into it, additionality is the most difficult one to get to grips with in many ways, but let's have a go. Right, additionality. GHG reductions are additional if they would have only additional if they would not have happened if there wasn't a market for them. So if somebody was going to save GHGs anyway, regardless of whether they were going to get paid for them as a credit, the argument is that wouldn't really be additionality. And you can see this starts to make life quite interesting and quite difficult. And in the small print here, I've added the issue that the Paris Agreement, with countries setting increasingly high targets for what they're going to reduce, arguably reduces the availability of additional GHG reductions. Now, this is when we're looking at GHG accounting in the global aspect of it. There is an argument, excuse me, there is an argument that at a more local level, that when you're looking at it, if you're trying to offset, does it really matter if it is additional or not? We could, I'll be honest with you, we could have an entire webinar on the issues and the complications of additionality. I think what we'll say today, it is an issue that needs to be looked at, and it is something that could be complicated, but we can work through it. Okay, permanence. Now, this is far easier to understand. An offset credit must be permanent, i.e., if I'm telling you that I'm taking 100 tons of carbon dioxide out of the atmosphere, I can't then later on go and put that 100 tons back in the atmosphere. So you need assurance that the removal is permanent and it's going to stay out of the atmosphere. So that's permanence, and it makes an awful lot of logical sense. Another interesting area, and can become complex, is unique ownership. I'm going to say there have been cases in terms of carbon accounting where double counting for savings happens more than once. Somebody does a renewable project and they say, oh, we've saved 1,000 tons of CO2, and they claim it. They then go and sell that 1,000 tons of CO2 as an offset, and somebody else claims it. Then we're arguably, if we're looking overall, they're supposed to be 2,000, but they're not. So what we have to do is when a carbon credit is traded, it needs to be recorded in a registry, and it needs to be retired to prevent it being sold a second time. And again, this adds to the quality and the nature of a carbon offset. Okay, so that gives you the basics. We know that if we're going into the marketplace, we're looking for good quality offsets, ones that can demonstrate additionality, permanence, and unique ownership. But here's part of the problem. This is taken from an article in a UK paper, the Daily Telegraph, but it's also been reported elsewhere. And I don't really apologise for the picture of the Wild West, because they're saying the carbon offsetting Wild West. Now, this particular article was referring very much to the case of people offsetting for flights and personal offsets, of which there are many, many providers out there. And, you know, the language used here was that, you know, people are at risk of being ripped off. We also know of cases, there are cases in carbon trading of organisations, people that have been, have broken the law and have ended up in prison for selling carbon offsets that don't exist. So this is the word of warning. And part of this is it's an emerging market. It's a new market. We've yet really to have universal established standards for that everybody subscribes to. However, we do have a number of approaches and standards that we can look to. The gold standard, which is very appropriately named, isn't it? Because we know where we are with that. Gold standard established in 2003 by the World Wildlife Foundation and other NGOs, and their interest was to ensure projects they had integrity and they contributed to sustainable development. And you can see there 1,800 projects, 142 million tonnes. If you buy or get involved with carbon offsets that come through something like the gold standard, you've got both verification of the project and you have got certification. It's a case there that you know what you are buying. Another one of the major standards is verified carbon standard. And they claim to be the world's most widely used voluntary program. They have 1,600 VSC projects and 500 million tonnes. It's quite interesting when you look at that as to who's claiming who's what, who's the biggest, who's the best. Part of that will be the marketing of it. We also have a quality assurance standard and with that there's a 40-point checklist that must be satisfied and auditors required. One of the things that we are awaiting is an approved and issued global international standard for carbon offsets. And as I say, in the absence of mandatory and an ISO standard, the private sector has stepped forward to sort of provide the sort of regulation and certification in the marketplace. And whilst we're looking at that, I think it's worth us touching on the International Carbon Reduction and Offset Alliance. And this is basically established as an organisation for people within emissions trading to promote the best practices in voluntary climate change and offsets. So we have a range of checks and balances that are there, but not quite as standardised as we would like. But one of the things we could do here, we could take here a quick glance at some players that are in the Canadian market. Offsetters, ACT, Tree Canada, Bullfrog, which will probably be known to many, Shell. All of these organisations are offering retail carbon credits. Some of them are offering them at what I call the personal level. Some of them are offering at the corporate level. They're all slightly different, and one of the problems that you've got is making your decision as to which is the best, which ones should I use, who should I sign up with. And I'll be completely open about it. That's an area that 360 is looking to help you with, because do you want to, are you going to become an expert in emissions trading, or do you rely on somebody else? Okay, so we now know what kind of offsets we want. We know that there's an emerging and growing marketplace out there, and I guess one of the questions that you'd want to ask is, how much do offsets cost? And that's a great question. And the answer I'm going to give you is probably one you're not going to enjoy pretty much, but would you believe they can cost anywhere from $1 a tonne upwards? I'm going to suggest to you that if you're paying $1 a tonne, you maybe are not buying a high quality offset. I think it would be dangerous and irresponsible to start quoting prices from particular offset providers here, slightly out of context. So I thought it would be interesting to have a look at the global markets where there are carbon prices that are established in, should we say, within the mandatory programs, because that's going to give us, if you like, an index that we can look at to consider what price carbon might be. And I've got two slides here to have a look at this. You can have a look there at the top of the shop is the Swedish carbon tax. And I don't know whether this is anything to do with Greta Thunberg, which is maybe coincidental, but they are paying $119 a ton, US dollars a ton. And you see, you can work your way down there. And at the bottom of this, we've got $26 a ton, France at 49, and so on. We also have the European emissions trading scheme, which is probably one of the longest running carbon markets that there are. And I thought I'd give you a snapshot on that. And you can see here, and this is the lifetime costing of emissions, or this is in euros per tonne from April 2008. And as you can see, for a long time, it was quite low, below 10 euros per tonne. It is now increasing. We only really expect emissions prices to increase as we go forward, as there's more and more requirement to reduce, as there's going to be, will there be availability? Market forces are going to take place, supply and demand. Okay, so how can you make a financial case for offsets? Well, a starting point is, unless you've got a strategic business reason to reduce your carbon footprint, why on earth are you even talking about buying carbon offsets? So that's got to be the starting point. And then the next test really is if your energy efficiency and abatement measures that you can do are a lower cost per tonne, then they're going to be the best option. Because you're going to reduce, if you can reduce energy, you get the saved energy and you don't spend the money on the carbon. However, if you're at a point where you can't afford, you've done the low cost, the effective energy efficiency measures, it's quite possible that good quality offsets may be a more economical way of hitting your target. But I make the point again, you tend to get what you pay for, so you really do need to avoid cheap offsets. So can I give you a procurement checklist? Yes, I can. First of all, what kind of offset project is it and where is it located? Because that's going to tell you a lot about the quality of it. It's going to help you judge, is it good quality? Can additionality and permanence be demonstrated? So that's our first two of our criteria. Is there an accessible registry to track and retire the offsets? If there isn't, start asking questions. Have the offsets been validated and verified by a third party to one of the recognised standards? Again, if not, don't think you should be trading. And here's a question for you. If they're future offsets, what assurance is there that they will be delivered? You could literally be buying hot air. And does the vendor follow a recognised code of practice? I think these are all good practice, if you like, from your procurement process. So I've got two more slides to go, and the summary of what we've talked about today. You need to understand and measure your carbon footprint. Without that, you're not even in the game. You need to reduce your carbon footprint, if possible, before buying offsets. Only buy high quality if you want to have a real impact on the climate. Only buy offsets that meet appropriate standards. Above all, be an informed customer. Ensure that the offsets that you've purchased are retired. And a blatant advert, but yes, seek independent support. It is worth it. Have more expertise at your hand. And I even want to boil this down to 3 simple steps. Determine the amount of GHGs you need to offset and call that your net zero shortfall. Decide what type of offset you want to use. Having done that, procure good quality offsets to meet your shortfall. And clearly, 360 is here to help you with that. Okay, that was a gallop through offsetting, but I hope those that already understand it have been nodding their heads, and I hope those that weren't too sure about it have now got what I'd like to call a good basic foundation in offsetting. So I hand over to Julie for the Q&A now.
All right, thank you very much, John. We do have some questions, so I'm going
Great.
through them here. I'm going to start off with this one. So if we've got an offset, can you comment on the steps that a customer would take to prepare that offset for sale?
Okay, so if somebody's wanting to sell an offset, you've really got to get yourself aligned with one of the with a third-party verifier, somebody who can review it, certify it. For example, the measurements would probably need to be carried out to something like ISO 14064 in terms of measuring the GHGs. You want to have a third party who's experienced with verifying. Of course, one of the approaches is that you could be talking to one of the larger verification organisations like Gold Standard or whatever, and looking at going through that way. I think one of the things I would say, if you're thinking of entering the offset market, you need to do your research on how you're going to meet the criteria we've talked about, and perhaps lining up yourself a good partner to do your verification and certification.
Okay. So this is a kind of a general question. Can you provide some general comments on the Canada Clean Fuel Standard and carbon offsets? I don't know if...
I can answer that question ever so easily, which is, I'm afraid I can't.
Okay. I was kind of wondering. Okay.
But if I would not have a problem, depending who's asked the question. No, not depending on who's asked it. If you make a note of that, Julie, I will happily look at it and come back to it. And here's where I will make a point about how we like to work. We like to be honest. If we don't know the answer to something at this moment, we'd rather say no and tell you later on, rather than fudge it at this point.
Yep, absolutely. We will get an answer back on that one for sure. So I've got another one that's just come in. Do we believe that purchasing carbon offsets will reduce carbon taxes? Right now, there doesn't seem to be a method with the current framework.
This is really good, because this is where we've got the interaction, if you like, between government and private sector. You can actually look at it. You know, the voluntary carbon offsetting and everything we're doing is really about is very much the private sector. One of the things I would think is if the private sector, the voluntary markets, if they start having a really noticeable impact, then arguably this should mean that government notices that emissions levels are falling, and therefore perhaps they don't need as tough or as draconian a carbon tax. That's the theory. The practice I'm not too sure about, because how good will government be at knowing what everybody is doing out in the voluntary markets? But in an ideal world, I would like to say that if we all get really good in our sort of voluntary markets, that we'd start making the achievements that government wants, and therefore it doesn't have to force us by means of taxation.
Okay. Thanks for that. What policies would you like to see to establish a more standardized voluntary offset marketplace and less of a gray area?
Yeah, I think that the challenge here, and it comes back to the thing where we said it doesn't really matter where in the world your offsets are, because we are all, you know, feeding into the global bathtub. So we can't seem to, it's not sensible that we rely on regulation from one government. What we do need, and I do know it is being worked on, we do need something like ISO producing a standard that can be used globally, that can be verified. I think that would be a major step forward. We perhaps, maybe it's a role that the United Nations could take on in providing some standardization there, because we can see the private sector picking up and running with ideas of standardization. We're seeing this in finance with the TCFD. But at the moment, one of the problems we get is an awful lot of private players, shall we say, are vying for position within the markets. But yes, I think the next step we need to see forward is we need one or two published standards from a body like ISO, which are global international standards that can be worked to, with verifiers trained to deliver those standards, so that we can move forward. And we've got a. Wouldn't it be wonderful if there was a common standard that was one standard globally? I don't think we will see that. I think what we will see is a number of standards, and then it will require overview to determine the equality of those standards.
Excellent. Can you comment on which industries are you seeing as best poised for generating or producing offsets for sale, like within like forestry or renewables? Yeah. Or
yeah, I think that's good. And again, we've got the issue, if we put to one side the additionality issue, one of the ways of looking at it is if you could reduce your emissions that exceed what you would have, then you've got a surplus. So what we're looking for is an industry that could arguably generate more carbon saving than it needs. So if we look at that in a simple approach, if we had a manufacturing plant that was generating renewable energy and it could generate 120%, it could use 100% for itself. It could then have 20% that it could trade as offset. But I think, as we saw with the absorption projects, these are clearly a very interesting area. So agriculture, horticulture, market gardening, whatever you want to call it, the greenhouse sector, they are all people that could really be looking at this. But where they're going to have to look at it is, do they generate an offset and sell, but don't claim that they are net carbon zero themselves, or do they try to achieve a net zero? And I think that's going to depend a lot on the pressure from the supply chain. So if we discover that Walmart and Lowe's and other people like that are saying we want net zero vegetables, then the grower is going to have to demonstrate that they've produced them in a net zero way, and then they might not have the offsets to sell. As you can see, it's a whole new area we're moving into, and I think we know the theory of it all, but the practice of this in the marketplace is going to get quite interesting. On the other hand, if you, in terms of the potential buyers of offsets, we find that commercial organisations like banks and people like that, that they may well be, and financial institutions, they may well be ones that are looking to buy offsets to sort of clean up their act, so to speak, because they feel the pressure to report that they are net zero. So not a very clear answer, but I think it comes down to the question is, can you see that could you invest in something that's going to reduce emissions and then sell it as an offset? If you think you could be doing that, then you are somebody who should be looking at it.
All right. Got a time for a few more here. If you're buying carbon offsets, are you buying RECs or voluntary? And if voluntary, where would you be buying them? For example, like which exchanges would you trust?
Okay, that's where we start getting into some complexities. When we start looking at RECs and things like that, and we start then arguably we're looking at are we buying genuine renewable energy, which is something I haven't touched on within this webinar, and is arguably a whole issue in itself, because a number of people's approach to reducing their carbon is to say we're going to have an approach whereby we procure renewable energy. Well, how is that certified as being renewable? So that's one aspect, and you could argue when you're doing that you're not really offsetting. At the moment, there isn't a single uniform marketplace, common marketplace. and that is part of the challenge for somebody buying offsets. You can go through one of the larger organisations that we referred to earlier, or you can almost do a peer-to-peer arrangement where, you know, you were talking about somebody who may have offset potential. They could be individually selling offsets without going through an open marketplace. In the terms of there being an open marketplace, should we say, like the stock exchange, that does not really exist. And it's an interesting model. How could one of those exist? It theoretically could, but at the moment there isn't one. Or if there is one, I've missed it.
Okay, so we've got a couple more questions here. How do organizations actually measure their carbon footprint, and what kind of formulas do they use?
Fine. Okay, that's a nice straightforward question. As I mentioned, carbon is, you've got to measure it by proxy. So what you've got to do first of all is you've got to identify what are the activities that you've got that lead to emission. So, for example, using electricity, burning natural gas, they're two very obvious uses that are going to lead to emissions. You need to be able to accurately quantify them, and in terms of carbon accounting for offsetting over a period of a year, say your accounting year. The clever bit then gets in converting that to carbon. Now, in terms of gas is probably far easier, because we know from chemistry, we know how much carbon emissions there would be from gas. However, there is the energy that's used to get the gas from where it was extracted to where you are, so you have to take account of that, and then you end up getting a conversion factor. With electricity, it's far more complex, depending, have you bought grid electricity, which may be a mixture of different electricity supplies? Are you buying direct from a single supplier, say Bullfrog, where they can say it's zero carbon or whatever? You then have to use carbon accounting factors. Depending where you are, various jurisdictions around the world have, the government may publish what they regard as emissions factors that you can use. Certainly if you're within a mandatory program, there will be a listed emissions, but I can tell you that sometimes those emissions are not necessarily the ones that you would use if you were going voluntary, because I can think of one program I know where they've set an emissions level for electricity that's been the same for the past 5 years, which the grid itself is fluctuating and changing. If you then move on to other aspects, it could become far, far more complicated. What we refer to as scope 3 emissions. So that's your supply chain and things like that. But your starting point to measure your carbon footprint is to start with what are called scope 1 and 2 emissions, which is the electricity you use and the fuel that you burn. So that would be gas, diesel or gas into vehicles. Accurately measure that, have a good measure of that, know exactly what energy source it was, where it came from, and from that, then the appropriate factors can be determined, and then we can end up with a carbon figure.
Okay, I'm going to take 2 more questions here, and then we're going to wrap it up. I know we've got a lot of good questions, but if anybody doesn't have their questions answered today, we will be answering those questions via email and sending the answers out to today's participants. So second last question, any comments on biofuels replacing traditional fuels? Yeah.
It's got to be a solution that we've got to work with. I touched on Boeing looking at, they've now claiming they're going to have a 100% biofuel plane by 2030. But excuse me, here we get a problem, like when people start talking about hydrogen. How is the biofuel being produced? Does it have environmental integrity, and is it a low carbon production of it? But I think there is a lot of scope there. Again, we need good standards. We need both standards and control. We need to know where it's coming from. We need an audit trail on it. But I think in the short term, it has to be a solution to the problem, because we can't go, I mean, if you listen to Mark Carney, and we in one of our newsletters, we talk about Mark Carney, he suggests that, you know, one of the solutions to climate emissions is that we go to everything electric, and we make the grid 100% renewable, zero emission. But you've only got to look around you and realise that you cannot do that at this moment. So yeah, biofuels is a key aspect, but again, you've got to look at the quality of it, and both from the quality of it in terms of, is it a good fuel, and does it have its environmental credentials?
Okay. So last question, and it's kind of a question I've gotten from a few people.
Yes.
Could you give us a bit of a sense of, has the availability of carbon offsets to the market, has that been growing, and how is that, I guess, balance between the availability and those who need it? How is that balance going currently?
I think that is a really interesting question, because we talked about additionality. Well, a carbon offset doesn't exist unless it's got additionality, and additionality says it wouldn't exist unless there was a market for it. So in that sense, it's balancing. What I do see in the short term is, if everybody's getting engaged and following what's been referred to as the race to net zero, and I'm going to make a comment on that in a moment, but we have got an issue here of how the supply market balances the demand market. I think at the moment, I don't think there's too much of an issue. I think that the supply market is there, but I think we may see an issue if everybody engages quickly, that we might find it more and more difficult, and particularly for additional offsets, as we mentioned, with countries setting their net zero targets, as you imagine, that is going to make it harder. But the comment I wanted to add, when I was talking with somebody the other day about this, the race to net zero, we have to point out that the race to net zero is not a sprint. It's a marathon, and but it's also a race that you've got to start now, because if you don't start it now, you're going to be trying to do a marathon as a sprint, and that isn't going to work.
All right. That makes very good sense. All right. Well, I wanted to thank John, and I want to thank all the participants here today. We had a whole bunch of really great questions, and I apologize that we didn't get time to go through all of them in this webinar. But as I mentioned, we're going to be doing a few things. Number one, we're going to be sending out a list of the questions and the answers to everybody that participated today, and everybody that joined us today. We're also going to be, this session today was recorded, so we're going to be making this recording available online, and we're going to be sending you a link to that recording as well, so you can go back and review it if you want to kind of review something that you might have missed during the presentation today. So again, I just wanted to thank you very much for your time and your attention today. And yeah,
Julie, sorry.
Oh, sorry, go ahead. Yeah,
sorry. I just want to break in real quick. John, thank you very much for a very informative presentation. And I hope all people, I want them to know who are online that we have a trusted advisor piece that comes out on carbon every so often during the month. So if that's of interest to you, we discussed various issues that are coming up in the marketplace that I think, based on the questions we're hearing today, I think would be of value and interest to people. So if that is something you'd like to do, please reach out to us and let us know.
All right. Thanks again, everybody, and hope you have a great day.
Thank you. Thanks for attending.